So if you look at the average trade size, it has actually, almost got divided by 8 in the last 12 years. And the share volume has actually gone up at the same time. And this goes to show that, now you can trade smaller size much more easily than bigger size. The messaging, as I said, that, every single day, 256 million messages are actually being created by the New York Stock Exchange compared to only 3.4 million trades. So that goes to show you the difference between the number of orders being sent and the trades actually being carried out with something which again goes to show those high frequency guys who are just like massively cancelling and replacing orders all the time. Okay, this is the share turnover velocity. How do you define this? Share turnover velocity is, let's say, a company is worth 100 billion market cap. The share turnover velocity is 100% if the notion trade for that stock is 100 billion. What it means is 300% is that in a single year, on Nasdaq listed stocks, they trade 3 times the market capitalization. Buy and hold, logic is dead end. I mean, at least in developed market, it's no more the case. People don't buy just to hold stocks for the rest of their lives. Turnover of 300%. For Nasdaq actually is now standing at 866%. Every stock trades 8.6 times its market capitalization in 1 year. So this is huge. I mean, the idea behind stock exchange is dead as such because people are doing it for, I don't know, speculative purposes, for high frequency market making, for statistical arbitrage, but not really for buying and holding. The reason I showed this to you is because if you got high frequency guys, they're going to trade more. When they're going to trade more, the share turnover velocity is going to go up. The share turnover velocity has been quite significant. Just don't look at Nasdaq because Nasdaq you had the dot-com bubble in 1999-2000, which sort of like there were certain days when a single stock would trade its whole market capitalization in one single day. The first day of its IPO, so it traded 100% of its market capitalization. So those were dramatic days. But it basically goes to show you the trend. The volume growth has been phenomenal. 570 billion shares traded. 2008, I mean, it's almost multiplied by 2. Why is not happening on Nasdaq? Yeah,
I'm still confused about what you actually do. But you mentioned in the beginning of your presentation that you do a lot of transactions and small transactions in milliseconds. So actually you create an illusion of a market, which is not actually there.
It's an illusion if you can catch me. It's an illusion if you can't catch me, but if you can catch me, it's not an illusion anymore.
No, it's an illusion that you actually create so that you can exploit the market dimension. So, I mean, isn't that how would you define that?
You're going into morality of the question. I'm not here for that. Okay, I get the point. Why do we do this? Liquidity. At least every time we want to trade, we would be there. We would always be there. For example, I'll come back to my book. I would always be there. So if you can hit me, if I'm not at 20, I would probably be at this price. But I would always be there.
Secondly, you mentioned that the regulations have destroyed the New York Stock Exchange. Why would regulations? I mean, those regulations were there to protect someone, right?
No, they were not. That's the whole point.
Why were they?
Because that was a monopoly. What do you do with a monopoly? A monopoly is, I know that if you want to trade time on a share, you have to come to me. Shamyl, for example. I'm giving an example. I can go to any price I want because you have to trade. I know you have to trade, so I can do whatever I want with you. I'm in such a powerful position that I can make you pay for my services.
So the regulation was there to stop this. So that's right.
Yeah, I mean, it has to destroy because that's what competition is all about. I mean, I'm talking about in terms if you're a shareholder of New York Stock Exchange, it has destroyed my business. But at the same time, it has given rise to some other guys who are really making a lot in this business. I'm talking about BATS. BATS was started by 3 guys back in Kansas City, in the middle of nowhere. They started with a capital of $2 million at that time. And now they have 10, approximately 12% of the New York Stock Exchange share. Those guys were entrepreneurial in nature, and they said, okay, the regulation is open. If we can have a good electronic system with which guys can trade, other clients can trade, why not? So that regulation has opened the door to these people, and at the same time, sort of like divided transaction cost by 2, and at the same time increased competition. Now, New York Stock Exchange cannot ask for any price anymore, because if they do that to you, that's the day after, it's going to sort of like misselect and classify you. And they've already done it twice, actually. They allowed you to trade on New York Stock Exchange stocks for 0 fee. They said, okay, for 3 months, you don't pay any fee. Come trade with us. So that is sort of like open.
That's because of high frequency trading.
Exactly. Because they knew that there are guys, I'm going to talk about those, niche players, Getco and stuff like that, who would come in and would say, okay, we are willing to market make for different stocks. Fine. I think I understand why you are working on the morality aspect of things, because you're just looking at it from a static point of view. But that's not what capitalism is all about. It's about, making sure that the market space in general benefits from it, and it has. So, it's the basic principle of fine art, the objectivism. That's what it's all about. That, you don't look at it from one single static point of view. You have to put yourself on the other person's shoes and look at it from the same perspective.
Yeah, but because of the current financial crisis, they want more regulation now.
Yeah, and that's going the extreme way now. It started in the right direction, but eventually it went the other way. So right now, again, the Democrats become extremely, leftist in nature, and I don't blame them, given, the problem with this financial crisis has been it hasn't been properly explained. You hear of all those bonuses, you hear of all those scandals associated with it. Nobody has come on and sort of really tried to defend it, because everybody who has tried to defend it has been like totally massacred by the press in general, which is always the case in this bubbles in this crisis. But the regulation serves the general purpose, but it does exactly the opposite when it's pushed to the extreme. We know it with Pakistan, for example. We closed down our stock exchange. You would never hear it anywhere else in the world. We close it down. You're sitting on share which is worthless because there is no market. You shouldn't even think of it. All your pension funds, all your mutual funds, there is no market anymore. You want to trade to BCL, go to BCL, because the state of the stock exchange is closed. So, that goes to show that regulation, and it was the regulator who decided, and eventually it was the right decision. It's being claimed now. But the fact is that when you push regulation to the extreme, it has some unintended consequences, which unfortunately our politicians don't understand. I'm not talking about our politician, I'm talking about American politician, I'm talking about the European politician. So nothing to do with regulation.
I was just wondering that previously you said that you could just place orders with one specialist, but now you can do so in NASDAQ and your stock exchange at the same time. So the same order will be given to more than one places. So doesn't that also create false impressions of massive volumes which are not actually given?
No, because the volumes I'm giving you are the traded volumes.
No. In the order, previously also you could look at the specialist order book and get an idea where the market might be going towards. But now if that one share, that order is being placed in more than one place, then how do you get an idea where the market is going? Because
okay. That's why they came up with a thing known as consolidated tape. A consolidated tape is now when you open an order book, it's consolidated for 5 different exchanges. So you don't know where your order is going to be routed. You might hit 2001 without knowing that it would go and trade at batch. You don't know. It could be New York Stock Exchange, it could be NASDAQ. And there's another thing which the regulation, the Reg NM has changed, what we call the trade-through rule. The trade-through rule is very simple. Two books, New York Stock Exchange, NASDAQ. Somebody places an order of 20.01, which is better than the New York Stock Exchange. Now, if somebody goes and trades at 20.00, that trade would be cancelled because there was better price elsewhere. So the regulator is forcing you to pay the best price. And if you don't do it, your broker goes to jail. His license gets revoked, the license costs $10 million. So you might have some financial difficulties. Sir?
Sir, you said in the presentation that involvement of a human element is being minimized in the broker business, and stock one broker has to send to 4, 5, or 6 exchanges at the same time. But even then, in Pakistan, we witness that the single person manipulates the stock exchange. Then, how does it happen? If all these processes are being automated and everything is being transparent.
Manipulation doesn't require, the agreement of the market maker. You can manipulate stock price if you've got enough money, and if you're willing to do it.
Sorry, sir, once again.
I mean,
how
it doesn't.
A single person typically manipulates the whole stock exchange?
It's got nothing to do with the market maker. The market maker is just serving a purpose. He's not there to trade. For you. He's just, a broker. He knows that you want to buy. He would find somebody else to sell. He would match you up, and that's it. He doesn't manipulate anything because he can't do it. That's not his job. But if, let's say, XYZ has got $10 million in capital, the stock in question, the market cap is $8 million, and he's willing to, buy the whole float, nobody can stop him. Nobody can stop him. He can be. The only thing that can stop him is the public scrutiny, in the sense that the regulator would force him to disclose his position to the general public, that I own 100% of the stock, in which case he would be in the board of directors in any case. But manipulation has got nothing to do with the market maker. You can manipulate anything you want as long as you've got deep pockets, and as long as you've got a game plan. Because why would you want to manipulate something if you got 100% of it? See what I mean? You might want to buy 100% of it, but for what reason? Why would you buy it for 100%? Either you want to take control of the company, and for that, by the way, you don't need to buy 100% of it, or you're just doing it for speculative purposes. You're just, sort of like running up the price, and discreetly selling, your own share once the bubble has happened. But for that, you need to buy when nobody knows. Because if the stock is going up, everybody knows that something is going on. And that's the beauty of momentum trading. That if the stock starts going up, somebody's buying. So the idea of speculation, manipulation is that you very discreetly start buying. Nobody knows. You end up having a very significant amount of market share, in that particular stock. And then all of a sudden, you start that marketing campaign. And that marketing campaign can be press, can be anything you want to. It can be going and telling your competitor that there is something going on that particular stock, and he would jump in the bandwagon too. And you mentioned the retail investor is the last one to get, on board, and he's the first one to get destroyed when there is manipulation that happens. So manipulation has got nothing to do with market making. This profession is very clean in the sense it's over the counter. You cannot hide things from people, because if you do that, it's your own capital that you're risking. You won't do it. The best form of market regulation, I've been told, is when your own money is at risk. Because when your own money is at risk, you won't do anything. You're going to be more responsible. It's a question of responsibility more than anything. I'm just going to finish up because I'm going to attack something which will be much more interesting for you, because that might be something that's a bit boring for you. Okay, what high frequency guys are responsible for across assets? So I'm talking about US equities, Europe, futures, options, and foreign exchange, and where the percentage volume is. So the guys are responsible for 66% volume of everything that's being traded in the US. 66% of everything that happens is because of these guys. Europe, it's 35%, but it's going really fast. Because the regulations opened up only last year. US futures 40%, Europe futures 40%, Canadian equities, US options. Option is much more difficult in nature because options require a lot of formalization in market making. We won't tackle it today. The reason I put in Brazil is to show you what's going on outside developed markets. 5 to 10%. So it's just a question of how developed your market is, how strong your regulation is, and where you go with that. Foreign exchange 10% because there is no single market in foreign exchange. Foreign exchange is not a regulated market, and that's the biggest problem. You want to trade euros, you want to trade pound, you want to trade Swiss francs, you can call approximately like 200 brokers, forex brokers at the moment in the world. And the biggest are actually banks. The biggest is Citigroup and Deutsche Bank. There's no regulation. You can trade at any price. There's a lot of competition going on, but the fact that the regulator has never looked into this market has ensured that this market is not really fast. So if you look at the low latency, it's not the case. It trades on average, takes on average 2 seconds to trade $1. And on top of it, there is something which is really particular in the forex market. You want to trade, you send your order, the broker is going to say yes or no in 2 seconds. So he can quote and then he can refuse, which is not the case in equity, because if I'm, sort of like studying the book, I have to trade with somebody else. I cannot say 2 seconds afterwards, oh, finally, I think I've changed my mind. In forex, he can. So in 2 seconds time, he can think over it and say no. So it's a market which is not really opened up, but in the G7 summit, that was one of the proposals. So eventually, maybe in 5 or 6 years' time, this market is going to start opening up. So this is the share of high frequency guys in the US alone, 2005 to 2009, and how it has developed. 33% only in 05, 09, 70%. Same for United Kingdom, so I'm talking about FTSE 250 shares, 12% to 27%. So you see the same trend across the board. The US has got a huge advance as far as those guys are concerned, but Europe is beginning to sort of catch up. So who are these guys finally? You would never hear of these guys. Investment banks have prop trading groups. These prop trading groups, there are high frequency guys, 3 or 4 guys running high frequency activity. But the majority of this activity is actually done by some entrepreneurs. Usually the size of these firms is 5 to 20 guys, usually based in anywhere they want to, because the servers are co-located in exchanges. They could be in Zug in Switzerland, because it's like the most interesting destination. Because of taxation reason, 30% of taxation is the lowest in Europe at the moment. Gibraltar, it's got the same tax incentive, and Luxembourg. So 3% of these firms are responsible for 60% of trading. 3 guys. I won't name them, I can't. But it goes to show that in a lot of firms, everybody has its niche. Some are dealing only with equities, some are dealing with derivatives, some are dealing only with forex. Everybody is taking care of its niche business. And since these guys are entrepreneurial in nature, most of these guys, they don't want to run big firms. So they want to run it with 5, 6, 20 guys, but no more than that. So it's not an investment bank where you've got 10,000 people working for you. So it's kind of interesting that 3% of firms, like 15 majors, account for 60% of this activity. These are the guys. We never hear of them apart from maybe Citadel. The difference is usually in the news for good or bad reasons. Dr. Jim Simons from Renaissance Technology, $5 billion in profit last year, bigger than any other investment bank minus Goldman Sachs. Millennium Israeli Glander, firm which is like really making inroads. But you get the idea. Nobody knows these firms. They are in the middle of nowhere, usually hidden from public scrutiny. The issue I talked about, huge operation in India, not trading operation but research operation, all run out of India. But goes to show that every time you trade every time you trade your stocks, 70% of the time you're going to be trading against some of these guys. Getco it's a huge name in equity market making, because that's their niche market. Ronin, again, forex trading, they're very well known. But again, I just wanted to highlight the entrepreneurial nature of this activity. How do you classify these firms? Again, the main players by majors. These are the majors, small and mid, and of course what they're doing. The main players again are Getco, ATD, TradeBot, IMC, October, Sun, and leading IB props. Leading IB props, you've got Goldman Sachs, Credit Suisse have been by Societe Generale. Very small activity in terms of headcounts. BNP, they're only 6. Credit Suisse, only 4. But the firms are 15. The asset managers are over 500 million. The revenue generated by these guys was around, because these firms are private in nature, they don't disclose their profits. For last year, it's somewhere between 30 to 20 billion dollars. That's actually more than the top trading groups of all the investment banks together. Small and big, a lot of firms like that. There are 400 firms now. Everybody in its niche sector and trying to sort of like, some assets actually 5 million are worth like that, but it's more like 1 million. I know of a firm which got total assets of $1 million, and every single day they trade 400 million shares. You know, when I say making money out of nothing at all, it's because here's the beauty of this activity. You are a hedge fund. You got 1 billion euros in capital. You generate 200 million profits. Your net return is 20%. But you need 1 billion to start with. Okay, you can take 1 billion, then you can leverage it by 5. So you got 5 billion to start with. And then 5 billion, let's say you generate 10%. 10% of 5 billion is $500 million. $5 million and 1 billion is 50% return. Impressive. Why not? Imagine a guy who comes in and says, I've got 1 million, everything included. Everything included. Your setup, your infrastructure, your servers, everything, your co-location, everything. This guy trades 500 million shares every day, generates 100,000 euros every day. For the year, he generates $25 million. $25 million over 1 million. And on top of it, here's the beauty of it. The margin rules kick in 10 p.m. after the markets have closed. That's when they calculate your margin requirements. That you need to post $1 billion to have a $5 million position. Starts at 10 p.m. Now imagine at 10 p.m. you don't have any position. So the capital requirement is actually 0. With 0 capital and $5 million in profits, your net return is actually infinity. That's where all these firms come in. Very small capital, huge entrepreneurial spirit, and some really decent profits. Again, as I said, by specialty, I'm just taking the firms who are the big guys in this field. Get goes to trade both for equities. Futures, it's actually the biggest business. Renaissance, as I said, it generated $5 million only in futures. So I'm talking about the S&P 500 futures. So all the futures actually quoted on the Chicago Mercantile Exchange. The futures quoted on Eurex. So you've got Eurostocks, you've got DAX, you've got Bloomberg Shat, which are the interest rate futures. And then you've got the Japanese futures. So you've got Topix, you've got Nikkei, and you've got JBLs. JBLs are the interest rate futures for the Japanese markets. So again, some funds are gradually making inroads in the Asian market space. So Optiver, it's actually a Dutch fund. It's really making inroads in the Asian equities. Okay. I gave you that number between the revenue generated by these guys was rumored to be around 30 to $20 billion. So how does that compare with investment banks? These are the world's biggest investment banks: Goldman, Credit Suisse, UBS, Morgan Stanley, Deutsche Bank, and the two French banks. I've just highlighted the prop trading revenues for their equities business and their fixed income business. All included, they generated $17 billion for 2007. I'm not talking about 2008. 2008 they were actually negative. Some guys made a lot of money, some guys really lost a lot of money. But that's 2007 before this crash really hit in. That was the peak of the prop trading for investment banks. So it doesn't compare at all with those high frequency guys, street small guys who are giving them a run for their money. Again, on top of it, Goldman Sachs says that it generated approximately $9 billion in prop trading. The total IB revenues were $34 billion. That's only investment bank. And then Goldman Sachs is their asset management business. In total, their revenue for 2007 was, I believe, $45 billion, which sounds like a huge number, but the compensation costs were 21 billion. So at the end of the year, for shareholders, the total profit was less than 11 billion. So those numbers don't mean much. So the idea is to give you a comparison of what 70 billion is compared to what the high frequency guys are doing. And what's going on? This is the JP Morgan revenue growth assumption for investment banks. Where would these guys be in 2010? Just look at these numbers. Flow, prop. Again, let me distinguish between flow and prop. Flow is everything that's coming from the flow side, which is the client side, and prop is what you're doing with your own money. Just look at those numbers. 2007, 2010, equities prop would be down 85%, fixed income prop would be down 86%. So, as far as investment banks are concerned, we're never going to see those revenues that they generated in 2007 anytime soon. I'm talking about 2011, 2012. Maybe they're going to get back at the same levels. I doubt it, but that's where they stand. So, all this to say that those guys might be big, but they're really small street fellows who are really good at what they do. What's the future of this business? So as I said that in US 70% of equities is actually being carried out by the high frequency guys. 50% in options. So where are they going now? Their biggest problem now is there's too much competition going on. You've got to get even better. So they're expanding it. Their activity to other geographical areas, notably Asia. Asia has been quite slow in regulation, except with the only exception in Korea. South Korea has been quite open with this regulation and stuff like that. But they're moving more into regions like Europe and Asia, higher speed, higher connectivity, modifying regulations, increasing competition. The problem is the derivatives market. The derivatives market, a lot of these guys haven't had as much success. It's because the maker-taker model, as I explained in the equities business, does not exist in derivatives. In derivatives, I'm talking about futures and options. You don't get paid rebate to trade futures or options. That is changing actually. The Chicago Board of Option Exchange recently introduced a maker-taker model, so they're going in the right direction as well. It's going to take some time, but eventually I think they're going to get there. Slow and steady. Finally, just about the myths that we have about high frequency guys. And what's the moral reason for these guys? These guys generate $15–16 million a year. Where does this money come from? Who are they taking it from? Are they taking it from the pension people? Are they taking it from the mutual funds? But predatory HFT algo just came from net traders. I'm actually quoting from Wall Street Journal. It's like the most reputable newspaper in the financial sector. Liquidity provision has always come at a cost. No matter what you do, when somebody calls you and asks you for a price for anything, I'm not talking about stocks, I'm talking about life in general. You don't know what information he has got. And you would never know because he's never going to show you his hand. It's like poker. He's never going to show you his hand as long as, he's trading, right? He's trying to make his living, you're trying to make your own living. But you don't know what he knows, and he knows that he knows something that you don't know. Which means that you're in the dark. You're taking a risk. On top of it, you don't know what that risk is. When he asks you for a price on Google, he might know something about Google that probably you don't know. When he's asking for a price on Apple, and I'm supposed to quote an Apple, I don't know what he's talking about. He might know something from Taiwan, from his connection, because his wife's brother is somebody in Taiwan who is generating some chips which are being used in iPhones, for example. I don't know that. Nobody knows that. So I take risk, and I need to get compensated for that risk. The money I generate in market making is actually compensating for the risk that I take. I might take a position and eventually I get totally destroyed because this other guy knew something that I didn't know that became public 2 days later. So I think it's a total myth that you say that high frequency guys are sort of like taking money from you. They are actually getting compensated for providing liquidity to the market space. Again, that's the second point that I just talked about, that the profit comes at the market's expense. So what? I mean, you have to get paid for liquidity. I'm not doing it for my own comfort, right? I'm doing it for a purpose, and that purpose is liquidity. And again, other thing is that people say that if you win and the other guy loses, it's a zero-sum game. And that's the problem. It's not a zero-sum game because there are different time frames. I trade in milliseconds, some other guy trades in minutes, there's a guy who trades for months, years. When George Soros puts position for 2 years, for example, and he starts with $1 billion, that's his first bet. So when I might be making money, he might be losing at that particular time, but he's holding on to the position, he might make a lot more money than I would ever in that activity. So there are different time frames, there are different strategies. I might trade against a guy who trades Google, but this guy is, no, not Google, let's say, let's take some other name, Time Bomber. I trade against a guy who's, I buy, he sells, but I don't know that he might be doing it for convertible arbitrage business. He might be putting on position convertibles, but I don't know that, right? I just made money on the spread, but this guy, he made money on the convertibles. So it's not a zero-sum game. Of course, somebody's going to make some money, somebody's going to lose some money, sure, but it's not a zero-sum game as such. Co-location gives high-frequency traders an unfair advantage. Well, proximity has always been an advantage. Rothschild made a killing in Paris Stock Exchange, and that's actually the reason for so much of his wealth, because he knew about the Waterloo before anyone else. The Rothschild, I mean, they had a pigeon business, communication through pigeons, and they were running it back then, and they were the first ones to know that Napoleon had been defeated. So those guys had some advantage over others, but that's the name of the game. Somebody would always know more than you. So proximity has always been the case. I mean, if you're trading your equities from Karachi, for example, and you're trading it on the floor, of course there's going to be an advantage. That's how it is. If you think you want to compete with those guys, go co-locate yourself. But I agree that, the platform is not fair. You have to be in the big boys league just to go against them. But the fact is that that's life. You can do anything about it. Not real liquidity. That was the question that you put for the gentleman there. That it's an illusion. It's not real liquidity. I'm just flooding the book, but I might have no intention to trade. And I will run for exit as soon as there's a market dislocation like Lehman Brothers bankruptcy. I will go away. But that's not true, because finally, as I showed you, the spread, if you normalize it with volatility, the spreads are at the lowest level. So those high frequency guys were there. They had to widen the spreads a bit, because that's normal. The market is much more volatile. Before, the market used to move for certain stocks 2%. After the Lehman bankruptcy, they were moving by 20%. We saw stocks like Goldman Sachs, just like the biggest blue chip stock in the whole wide world, move by 25% one single day. So that's how it is. I mean, and if there's so much volatility, I have to change my algorithms. I have to make sure that I keep track of the volatility. And finally, high frequency traders churn books to earn rebates. Again, that was a question of the lady there. That's it's an illusion of notional trading, but that's not true, because rebates are not necessary for profit. Rebates, as I said, was only $4 billion last year. Their profits were around $15-16 billion. So even if you take rebates out, you still got $12 billion. Yeah. Yeah, sure. I mean, actually, it was the last. But
the objective was to make this session as interactive as possible. So if you have questions, please ask now.
I understand that most of you here are not interested in finance. They are more from marketing, supply chain management, as I've been told. And I understand doesn't interest all of you. The idea, as I said, to organize it, is to introduce you to a certain activity, tell you where it stands, and that's it. If somebody is really interested, you've got my email. Feel free to contact me. I'm more than happy to guide you in any case. Questions?
Start off with presentation of the participation regarding neighborhood and smoking. Yeah. how do you relate this that quotation with this price?
I love her. What was the quotation? You're so misunderstood. That's the point. The second is very misunderstood. It's, you know, people say it's not moral, it's not legal, it's something which is not supposed to exist. And the idea is actually to show you that it serves a real purpose. Without these guys, the markets would be super wide. It won't trade as much. Now it's so liquid. I mean, honestly, with some liquid stocks, you can do whatever you want to without worrying about it. Imagine you're an investor, you want to buy something. The moment you get into that stock, you know that you've got bid-ask spread. The bid-ask spread is costing you 1%. You've already lost 1%. If you want to get out of that position, you're going to pay another 1%. You've already lost 2%. Plus, you're going to pay the exchange fees, another 1%. So you've already lost 3% the moment you enter the position. What to talk about making money? Right now, these guys have made sure that there is no slippage. You can enter $10 million easily for 10 bips, everything included. So that has made market much more competitive. Without, I mean, had they been, if they were not there, the world would have been a much, much, much different place.
We've been discussing the New York Stock Exchange over here, LSE and all that. But when you come to the Pakistani market, we look at our stock exchange, for example. Last week it closed down, and things were at standstill for quite some time. And even now, we know that the stock exchange isn't really doing that well. It's still going down the drain. Could that be a possible reason why future trading is not very encouraged in the Pakistani market?
I think it's the biggest myth that you can have. I mean, I've heard the regulator. I had the chance to meet the regulator here because I really pushed my plan to start some activity in Pakistan because I wanted to come back to Pakistan. And so we met the regulator and explained to him that, you know, we are such big players. BNP Paribas, any given day, we're responsible for 15%. I was responsible for 15% of all the markets traded globally in futures in Europe. And I went there and explained to him, listen, why do you think that futures are detrimental to the market? And there was always this, actually, your statement that just said that, you know, if you have futures, I mean, there would be sell-off, and the sell-off would be sort of like exaggerated by the future sellers. But I explained to him that index arbitrage is different. What happens in index arbitrage? And that's what I was trying to explain to the gentleman. Okay, when I say cash, I mean stock exchange. I'm going to take an example of S&P 500. So we've got a future running on it. It's one of the most active futures in the world. We call it the SPO, trades at the Chicago Mercantile Exchange. It's directly correlated with your cash index of S&P 500. The problem is that, as you said, that the future trades all alone. So if somebody comes in with a huge position that hits the market in the futures go down. But he hasn't touched the cash market. So that's where I enter. I'm going to say, anomaly. Somebody has just sold future for 10 bips. I don't understand because the cash is involved. So I'm going to enter. I'll be buying futures. I'm a futures buyer now. So I'll be actually stopping that, that selling. I'll go against him. I'll just start putting on position. At the same time, I would sell the cash market in front and sort of like, put it in equilibrium position. So that I've just generated that extra amount. And at the same time, I have stopped the sell down. The problem again is that people who make decisions, and actually India they had exactly the same position 2 years ago. Eventually they relented because Citigroup, when they explained it to them the whole business that speculators will always be there. Why do you think speculators are bad? The whole .com bubble was actually, people blame the speculators on it, but they were the same speculators who were behind Google, speculated on their ideas. Speculation is good for, industry in general. The problem is when, it goes to the other extreme. But eventually I think it's a myth. They would always, if you introduce a future, guys like us would enter the market. But if you don't have any futures, who would want to trade KSE 100? Because the slip rate in KSE 100 at the moment is like more than 2%. If I want to trade a whole index, somebody asks me to trade KSE 100. The bid-ask spreads are like that. On top of it, I have to pay the exchange fees. If by any chance the stock market is not closed, then maybe I can put on some position. If, for example, we had a future business out there, it's going to make the market much more liquid. So if I would just, buy the future, and somebody would automatically make sure that the cash market flows. So again, myths. You can't do anything about it. Eventually, they will. Ma'am.
With respect to arbitrage opportunities and everything, does that focus on the fundamental perspective of the securities as well?
No, we don't care.
It can be any stock, no matter what the future of the company is.
I traded Nikkei 225. Nikkei 225 is 225 stocks. There are no names, in developed markets like US and Europe. You've got names, so you can say it's Microsoft, it's Daimler. You relate to it. Daimler, I know BMW. In Nikkei, you trade 7201 against 7207. So you don't even know the name, but you know the statistical principle behind it. So you don't need to know the fundamentals.
Yeah. Actually, I want to ask that now that fixed income is gone for 2 years, at least for 2 years, don't you think the equity market should expand in the next 2 years? They should expand rapidly in the next 2 years. Why? You said the equity market will not expand in the next 2 years.
I said prop trading won't expand at that. It would take 2 or 3 years just to come back to that level.
Why would that be? Like now fixed income is gone. No,
fixed income is dead.
Yeah, it's dead. Now the only choice you have is equity. Why shouldn't they be?
No, when I said fixed income is doing really good, Goldman Sachs, all the results are coming from fixed income now, but not from the proprietary trading. It's coming from the client business. It's going really very strong from the client side. From mutual funds, from pension funds, from insurance companies, but not from prop trading. So I think I need to sort of make a difference between flow and the prop. The prop is there for the time being. And in any case, let me. See, we had some big prop from fixed income side, there was huge money, that was being made. But that particular activity is there. And again, you need to make a difference between this prop. There are two types of prop. One prop is, I'm a trader, I have access to 400 million of bank's capital. There's another prop which is being used by certain European banks, which is like a mortgage banker walks in, he buys $1 billion of CMBS. The thing is that he doesn't want to get rid of it because it's not his job. He just deals with other clients, and that's it. His job ends. That's how he's going to get paid. He gives it to the trading desk, sales trading desk. The sales trading desk says, I've got other stuff to do. This position is huge. What do I do with it? So what happened eventually was that position went into fixed income prop. So they gave it to prop trading and said, listen, we are stuck in this position. Can you do something about it? Now, that generated quite a lot of revenue in 2004, 5, 6 because, the prices, the ADX index, it just kept on going up. So there was absolutely no risk. Worst case scenario was that you would make zero out of it. The problem happened in 2008 because there was musical chairs and the music stopped. All of a sudden there was no prices. It was just like Karachi Stock Exchange. The market was closed for 8 years. Okay, I will just give you a small anecdote. I'm sure you have heard of this small firm known as Thornburg. Thornburg was the biggest mortgage specialist for California region. $16 billion company before it went bankrupt. Decides to go bankrupt on 29th of February. 29th of February on the leap year, which means that the closing is on 29th of February for all the investment banks. And investment banks have a thing which is known as mark-to-market. Mark-to-market is that you got your asset, you have got to market with the market. The problem is 29th of February, it's a leap year, and this guy says, I'm bankrupt. He doesn't decide to go bankrupt on the 1st of March, not 2nd of March. He wants to do it on 29th of February. A lot of banks went to see these guys and said, listen, hold on to the boxes, it's no big deal, just wait 12 hours. And those guys refused. Actually, they didn't refuse, Ernst & Young refused, which was their auditors, because they were the ones who were liquidating the company. And they went in and they called everyone up, and everybody knew that Thornburg was bankrupt and said, I don't care what price you're offering, in any case I need to sell. So people, it was a fire sale going on. They were just hitting every single price they would get their hands on. They had 38 billion in inventory in ABS index. That day, Bear Stearns and Lehman Brothers, that was the one reason that people knew that Bear Stearns and Lehman Brothers won't survive anymore, because on that quarter, they took the marks on all that Thornburg positions. So the prop trading guys on Lehman Brothers, they lost their shirt that day. Because they had bought the position at 98 cents a dollar, and when Thornburg was done, it was 50 cents. One single day. So prop group, we have to differentiate between these two activities. Something might come from clients, and all this profit generated through fixed income. It was not because those guys were really intelligent, it was just because things were going in their favor. Yeah, sure.